the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the final episode of Business Standards, the banking show. Yes, you heard that right. This will be the last episode of the banking show. For nearly 2 years, we brought you the story behind the developments in the banking sector every week. The banking show may be going away, but stay tuned for more exciting and innovative offerings from Business Standard in the future. Keep following us on business-standard.com or YouTube for more. My name is Kanishka Gupta and here is what we have for you today. In our cover story this week, Raghu Mohan tries to find out if MFIs are overcharging. In Banker's View this week, we have Ajay Kanwal, MD and CEO of Jana Small Finance Bank with us. What is Section 35A of the Banking Regulation Act and why is it in the news? That is what we are talking about in our Banking for You segment. Later, Tamal Bandyopadhyay joins us for his expert take. At the show's end, we will tell you the results of last week's polls question. Amid the newfound freedom in loan pricing for microfinance institutions, the RBI has raised concerns. Some microfinance institutions or MFIs have hiked loan rates significantly, prompting scrutiny and a call for responsible practices. Here's more.
The Reserve Bank of India has flagged concerns over the pricing of loans by a few microfinance institutions. This is the first time the banking regulator has raised the issue after the pricing of loans given by these entities were freed in March 2022, bringing them on par with banks. Guidelines until then had it that MFIs could charge on loans only 10 to 12 percentage points above the institution's cost of funds, or 2.75 times the average base rate of the 5 largest commercial banks, whichever is lower. RBI Deputy Governor M. Rajeshwar Rao on February 9 said that while lenders were quick to pass on the increased cost to borrowers, they have been reluctant to pass on the benefits envisaged under the new framework. He made it clear that irresponsible practices would compel the RBI to act. Some MFIs have been reportedly pricing loans at 25% thereabouts, which on a year-on-year basis nearly up by 200 basis points. So, are microfinance institutions being unfair?
It's not absolutely true that the MFI institutions are overcharging the borrowers. I agree with you that the pricing has gone up since the COVID time. It is mainly on account of 3 factors. One, the overall pricing has gone up across board during this period. Number 2, there was a cap earlier on interest rates put by the Reserve Bank of India, which is more of an artificial in nature. And third one, I would say that the credit losses suffered by the microfinance institutions during the COVID period, which is still impacting them. So because of these 3 things, the interest rates are little higher.
According to the report on trend and progress of banking in India during the financial year 2022-23, MFIs outpaced banks in microcredit disbursements, emerging as the largest provider of credit with nearly 40% share in the microfinance segment. Rao's observation resonated in the RBI's report as well. It said MFIs cater to marginalized clientele. The repayment capacity of borrowers need to be considered while extending loans. With the deregulation of interest rates, certain MFIs appear to be enjoying relatively higher net interest margins. And microfinance lenders, therefore, need to ensure that flexibility provided to them is used judiciously through transparent interest rate setting processes.
It's not correct to compare the interest rates of microfinance institutions with any other institution, especially the banks, because banks have always have a huge resource through the deposits, which are a cheaper source of funds. Whereas in case of microfinance institutions, they have to borrow from the banks or NBFCs, which make it more expensive, and there is a double intermediation happening. So it's an expensive one than the banks. But this is always helpful to the poorer segment of the people who do not get the credit from the banking sector or the normal channel.
The hope is that with a policy rate cut by the central bank sometime around the time of the full budget, after the poll results come in this summer, there could be a southward movement in interest rates. The MFIs will glide along.
Ajay Kanwal, MD and CEO of Jana Small Finance Bank, says that the first quarter result after the IPO was the best ever for the bank. In an exclusive interview with Business Standard's Manojit Saha, he also talks about the numbers after first quarter results, post-listing, and the growth strategy ahead.
Hello and welcome to the Business Standard Banking Show. Two small finance banks were listed on the exchanges in February. One was Jana Small Finance Bank, the other one was the Capital Small Finance Bank. Jana SFB has now announced its first quarterly result post the listings. It has posted almost 13% rise in its net profit to 135 crores in the October-December quarter. Ajay Kanwal is the MD and CEO of Jana SFB is here with us today to talk about the numbers and the bank's growth strategy going ahead. Mr. Kanwal, welcome to the show.
Thank you so much, Manojit, and I'm happy to be here.
Thank you. Jana SFB started operations in 2018. As on December 2023, the loan book was about 23,600 crore, while the deposits were about 20,700 crore, 800 crore. What is the medium-term growth strategy for the bank? I mean, where do you see the loans and deposits 3 years down the line?
Thanks. Thank you, Manojit. So first, let me start off by telling everyone that both me and the management team and the board in Jana are feeling very, very happy that our first results after the IPO were the best results ever that Jana has given. If you take our 9 months performance, Manojit, our deposit run rate is about 37.7% growth, 9 months.
Correct.
If you compare December last year, not 12 months, December last year to December this year.
Year-on-year
Our
growth,
asset growth rate is 27.7%. So two parts here. One is our deposit growth rate is running faster than assets, which is what I think everybody is talking about, the CD ratios in the industry.
I will come to that in a minute. Yes.
Correct. And
Yeah.
second is our asset growth is very strong. Now, what is not visible within the asset growth rate is the bigger portion is secured. So secured is running at about 40%, unsecured at 15%,
Correct.
which is the second decision in the industry of unsecured versus secured.
I will also
I
come to
think
that. Yes.
Not only numbers, I think on both the key strategic parameters of how fast is your deposit growth rate, how fast is your secured growth rate, I think we've got a positive 9 months, I would say, and of course a December quarter. You should expect the bank to grow very strongly in the future also.
So overall business is close to 50,000 crore right now. Where do you see it in 2 years, 3 years down the line?
You take any multipliers in the 20s
Okay.
and fast forward it, and I'm saying 20s, I mean, it could be plus or minus, whatever. But listen, like I said, for us, the most pleasing piece, in addition to the CD ratio, in addition to the secure, was the gross NPA, net NPA. Our net
Right.
NPA is down to 0.7 now. And why I mentioned that, Manojit, is, see, listen, we can grow at X% or Y%. But more importantly is to have good growth.
Correct.
And to us, that is more primary than growth by itself.
So the loan book is more than the deposit book, resulting in a CD ratio over 100%. When do you see this anomaly being corrected?
So I think one thing I want to tell you, is, see, we are very liquid first. We've always carried anything like, I remember, 1,500 to 2,500 crore range surplus liquidity. So liquidity is not an issue. Now, the question is, if you have deposit less than asset, then how come you're liquid? The reason is we've got super refinance from 3 large government institutions. One is NABARD, one is SIDBI, and one is NHB.
Okay.
Now, because NHB does affordable housing, which we have a large book of, SIDBI does for MSME, which we've got a large book of, and NABARD does group loans to our rural customers, which we also have a large book of. So we've got stable lenders, long-term lenders. So even though ratio is coming down, it's now at 104 or 105 in December, we are very liquid because about 5,300 crores odd, Manojit, is borrowings from these three institutions. And which is
Okay.
why, but if I really try and collect cash too much too quickly, then I will end up with a slight negative carry cost.
Now coming to the liabilities part, my question is on the CASA ratio. It's just 19%. Of course, there is much scope to improve. So, what is your plan to improve the CASA ratio, and where do you see the ratio over the medium term?
So absolutely right. So Manojit, one is, listen, we are a 5-year and 9 months old bank.
Yeah.
And our CASA ratio when we become 8-year-old or 10-year-old or 15 will be much better because, CASA is normally supposed to be a stable, slow growth number. Unlike deposit where you go after marketing, pay a good price, you get lots. CASA doesn't work like that. But CASA is more transactional in nature. It's more longer term in nature. So it obviously ends up being slower. Our aim is to really grow it much harder. And that is a function of more branches, more relationship managers. And we have just launched our 2 segmental offers, exclusive at the top end, and second is premier. Normally, when you have segments offers, they tend to get more CASA. So we are focused on it, but we are also focused that, listen, growing it artificially is going to make sure that, and you will suddenly see a bad quarter and it'll drop. We don't want to build like that.
Okay.
Second, if I build too fast, it will also end up being highly expensive for the bank.
Right.
So I think rather building in a very steady manner over the years, right? Because if you take large banks, large private sector banks, somebody's at 35%, somebody's at 40%. But listen, they've been in existence for 30, 40 years, yeah. They've been able to collect customers. The customers are increasing their savings, their wealth is growing. So they've actually managed to grow their CASAs. So I think we should take a more evolutionary path to CASA.
So, is there any number in your mind where you want to see your CASA as a 2-year or 3-year down the line?
Yeah, so I would like CASA to be like a 30% in the next 3 years.
Okay.
That's what we have said even in our several meetings. And so, which is why I said, between 2 to 3% growth each year would be a good, healthy growth, something that we can sustain and grow steadily.
You also have recently, raised money through an IPO. Post the fundraising, what is your capital adequacy ratio?
So I think if you add up everything, it crossed 20%.
Okay.
Yeah. So I think, and more importantly, so Manoj, 2 things. One is for investors, ROE now is at 20.5%. ROA is 1.7. On capital adequacy, out of this 20%, my tier 2 is only 1.5. Tier 2 can be 50% of tier 1, which means I can
Correct.
raise 10% more as tier 2.
Yes.
So my bias is, as time passes, because interest rates a bit, with better results, with, interest rates softening a bit, we'll be able to raise a bit of tier 2. And that I think will, keep us very steady. So we don't see a immediate future capital raise coming in again, because we have profit accretion. Like if you take our 9 months profit itself is 348 crores.
Yes.
Now you think that we raised capital in IPO 575 plus 348 already done, plus 1 more quarter to go. So I think we have enough room in our profit margins to add to growth.
Right. Cost income will be easily managed. On that note, Mr. Kanwal, it was a pleasure talking to you as always. Thank you for speaking to Business Standard.
Always pleasure talking to you, Manoj. Thank you so much.
Thank you.
Paytm founder and CEO Vijay Shekhar Sharma has stepped down from the board of Paytm Payments Bank ahead of the March 15 deadline set by the RBI. By now, we all know that the banking regulator has directed the fintech firm to wind up its banking activities by March 15. But did you know that the RBI exercised its powers under Section 35A of the Banking Regulation Act 1949? What is this section all about? Kasturi Akhil offers a detailed insight.
On 31st January, just a day ahead of tabling the interim budget, the Reserve Bank of India dealt a big blow to Paytm Payments Bank for persistent non-compliances and continued material supervisory concerns. The central bank barred its payments bank from undertaking any banking activity. It cannot take fresh deposits. It cannot undertake credit transactions in customer accounts. There will be no wallet top-ups, etc. The deadline has now been extended to March 15 from the earlier February 29. The RBI exercised its power under Section 35A of the Banking Regulation Act 1949 to act against Paytm. But what is it? Banking Regulation Act 1949 gives RBI the power to regulate and supervise public and private sector banks. Under the provisions of the Banking Regulation Act 1949, it can inspect the bank and its books and accounts, examine on oath any director or other officer of the bank, cause a scrutiny to be made of the affairs of the bank, give directions to secure the proper management of the bank, call for any information of account details, determine the policy in relation to advances by the bank, direct special audit of the bank, direct the bank to initiate insolvency resolution process in respect of a default under the provisions of Insolvency and Bankruptcy Code 2016. Meanwhile, Section 35A empowers RBI to act in the public interest or in the interest of banking policy. It empowers the banking regulator to prevent the affairs of any banking company being conducted in a manner detrimental to the interests of the depositors or in a manner prejudicial to the interest of the banking company. It can also give directions to secure the proper management of any banking company, and the company shall be bound to comply with such directions. RBI also has the power to modify or cancel any direction issued under Section 35A. Like on 16th February, it extended the deadline for imposing certain business restrictions on Paytm Payments Bank by reissuing modified directions under Section 35A of the Banking Regulation Acts 1949. But the directions issued under Section 35A by the Reserve Bank of India are not the final word. They can be challenged if found to be legally questionable. A master circular issued under Section 35A by the RBI in 2016, called Frauds, Classification and Reporting, allowed banks to classify accounts of willful defaulters as fraudulent without hearing them. This circular was challenged in the Telangana High Court, which held in 2020 that borrowers would be heard before the classification of an account as fraudulent, following which SBI and the RBI then moved the Supreme Court against this order. The Apex Court upheld the judgment.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
So the directions issued under Section 35A by the Reserve Bank of India are not the final word. They can be challenged if found legally questionable. Now that we are all experts on Section 35A, let us now move on to our in-house expert Tamal Bandyopadhyay for our next segment. In a chat with Ruchika Chaturvanshi, Tamal spoke about how long the bull run would continue for public sector banks and more. Here is the talk.
Hi Tamal, welcome to the Banking Show. This week in your column, you've talked about the bull run of PSU banks. Now, before we get into the future prospects of the PSU banks, can you explain why the bull run and why so much investor interest in PSU banks?
Yeah, thanks, Ruchika. If you have seen that the last year or so, or even a little more, the PSU banks' performance was far better than the stock market to how the investors have reacted to the PSU banks. So, in other words, the stock market, their pricing was not in sync with their performance. So now what we are seeing is that the PSU banks are being re-rated. investors have understood their worth, and there are many reasons behind this. They have gone through the hell that 2015, 16, 17, all those cleaning up, etc. that happened. They are much less adventurous now. The hard mentality is no more there. Their risk management, etc. has got far better, underwriting capability better, their growth is pretty good. So all these, actually, what you have seen, that there was a time when if a bank is trading one-time book, people used to say, oh, wow. Now you look at even the State Bank of India. Many of the banks are 1.5 times, 2 times book they are trading. So that's a great story. And of course, in adding fire to the fuel, or fuel, what do you call it? Fuel to the fire, or fire to the fuel? So you just think, is this the privatization story? And the two banks, public sector banks would be privatized. That's the announcement in budget 2021. It's not yet happened. So that speculation also is on. So all put together, it's a good story, and investors have discovered the PSUs. They took little late. The banks are being re-rated, and that's it was happening.
So then naturally, the second question is, how long do you think this interest will last? You've talked of a few factors in your piece as well about rising capex and the fight for deposits. What are some of the things that will play out for PSU banks?
Well, which can go wrong is the quality of assets. In fact, if you see the fresh slippages happening and the credit cost is going up, that will be a big negative. But if you see, the bankers have been saying that no, I mean, nothing to be worried about. It's a good story is there. And even the country's largest bank, one of the top 50 in the world, State Bank of India's net NPA is less than 1%. And most banks' gross and net NPAs, even though in relative term they are little worse than the not as good as some of the large private banks, but historically they are in the best position, I would say. So if that is taken care of, then there are two advantages that the PSU banks have over others. One is this: when the fight for deposit, particularly low cost deposits, is pretty fierce, they have their branch network. So the CASA, they will be in a better position to mobilize the deposits. That's the most important part, that the biggest challenge the Indian banking sector is facing at this point of time. And the second part is this, we are talking about capex. Private sectors is still shying away from investing. Government capex is there. The interim budget also announced the kind of money that the government will put in infrastructure and other areas and all. And if you see that the private sector banks are not very excited about the corporate loans, the long-term loans, which public sector banks, there could have been in the past government pressure on them, etc. But by nature, their understanding of this project financing, etc. Probably I would not call it better, but because their willingness to support, and they see also right now in their approach has changed. If they see money in it, if they see interest income in it, they will go forward. They will move ahead to support the capex ahead of the private sector banks. So which means their interest income also will go up. So both on the assets and liability side, they are poised to continue.
Now, moving away from traditional banking, we are seeing a lot of action happen in fintech sector. And recently, there was a meeting that FM took with fintech companies, which is not something we see often for any sector. And we had the FSDC meeting also, which talked a lot about the financial services sector. How do you see some of these developments in context of India's focus on building its digital public infrastructure?
Ruchika, I mean, I really don't know. You see, what is the provocation? The provocation is the RBI action on the Paytm Payments Bank. Now, I repeat, it's a Paytm Payments Bank. What does it have to do anything with fintech? But it came as a shock and surprise to the industry. And then suddenly the talk started about that RBI is anti-innovation. We have a regulator, which I would not like to name any individual or entities, but that's the campaign. Now, the entire thing, the issue has been hijacked by certain people. I don't think they have huge credibility in the industry, and then they made it a campaign saying that here is a regulator, and I mean somebody has gone on record. There are 60-year-old plus people who rule Reserve Bank of India. What do they know about fintech and all? But where does it come from? Is the action against Paytm Bank. Paytm Bank is not equivalent to innovations in fintech. So entire thing is misplaced. There has been a campaign, and it's a misguided, misdirected campaign. And rightly, the finance minister and the finance ministry and Reserve Bank of India have come to the fore to allay all the fears and all the, I would say, the misinformed campaign that, look, we have nothing to do. I mean, we are not against innovation. You should be innovative, look for innovation, but that does not, by being innovative, that does not give you the freedom to ignore the regulations. And I mean, suppose somebody, whoever has invented the car, and if there is no brake in the car, there is no care for everything and all, you can move anywhere you want, you can maul people, you can you can kill people, you can do whatever you want. That's not done. I mean, if you look at the Paytm Payments Bank history, the KYC norm, how with extremely scant respect, the KYC norms were violated. Now, KYC norm has nothing to do with fintech. What is there? It's a basic thing. It's a basic hygiene factor. So I think these are all misinformed campaign, and to contain this campaign and to actually reassure the industry, look, there's nothing to be afraid of. You be innovative and take the way forward. We talk about the public infrastructure for payments or everything else where India has been doing a phenomenal job. You move ahead, but that does not mean the freedom to innovate does not mean violation of regulations. You have to have respect for regulation. So there's absolutely nothing to be afraid of. The turf is extremely tough is there, and India has been in the forefront globally when it comes to payment infrastructure, and the story will continue.
So clearly, this has also given the opportunity to the government to look at the sector in a macro perspective and make sure that innovation is not curbed, but at the same time, companies follow regulations. Thank you so much, Tamal, for putting all that in perspective. So good to have you. We'll see you next week.
It is time now for our poll results. Here is what we asked you last week. Will you ditch your digital wallet in favor of UPI? Well, 74.4% said yes, they would, whilst 27.6% said no. This brings the banking show's journey to an end. We hope you enjoyed our reports on the banking sector. We will continue to bring you such insights on our website, business-standard.com, and also on YouTube. Subscribe to our channel and keep following us for more. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.